Coordinated efforts by the world's central banks have the cost of insuring European sovereign debt dropping today, but many top investors still saying stay away. Well, joining us now is Dan Janis. He's lead portfolio manager for Manulife Asset Management. In the latest issue of Bloomberg Markets Magazine, Dan's Strategic Income and his Strategic Income Opportunities Fund were both ranked number 1 and number 3. Number 1 and number 3, respectively, among all global bond funds. Danny, good to see you. Let's talk about what's happening in Europe. I know when I spoke to you, it must have been a couple months ago, you were not very interested in Europe at the point, and spreads there were then quite wide, and they've gotten dramatically wider. So at this point, is it starting to look interesting? It's
starting to look interesting to the fact where we always want to find an edge. And right now, I still think it's not to the point for us to feel that we have an edge, but the information that we get from the powers that be, from the ECB in the European situation, if they have better clarity, and they come up with a plan that we think is credible, that makes sense, and then we start to see the market buy into that, then there's a possibility that we may dip our toes in down the road.
Danny, for the last couple of days, before yesterday, markets were pricing in a 90% chance of a Greek default, 95, 98, 99, and eventually it was for sure going to happen. What do you think those chances are now?
Well, when I look at default, it depends on what the definition of. There could be a restructuring that may not be considered a default, in the CDS, the credit default swap terms. So there could be sort of a rejiggering or restructuring of that debt. I think there has to be, over time, some sort of restructuring of that situation. How they flower it and how they make that, to put together may be a little bit different than what we may expect.
Let's turn quickly to the U.S., Danny.
Sure.
We had the debt downgrade, obviously, back in the very beginning of August, but still, Treasury seems to be performing very, very well despite today's trade-off. You don't own U.S. Treasuries. Is there a point at which you get back into our sovereign debt market?
Okay, right now we have to admit that we had that trade wrong. We were underweight Treasuries. And we had a short 10-year future, which we took off because Bernanke sort of laid the foundation that we may have a runway of a year and a half to 2 years of stable rates. So it didn't look like that was the right trade for us. We have to learn that we're not stubborn and we take things off. But as far as opportunity now in Treasuries, the yield relative to our opportunity set globally doesn't make sense still. So I'd rather be out of that right now.
And you heard we had John Chambers at a conference saying that he thinks there's a 1 in 3 chance of another potential downgrade. Is that something you're watching closely? And at that point, I mean, we saw what happened after the last downgrade. We saw, Treasuries basically trade up. Do you think at any point there is going to be a catalyst to get back into U.S. Treasuries?
I would probably say at a 2 or 3% higher level than here, then we may start to look at that to replace maybe some foreign government holdings, but right now, no. But a potential downgrade, if we go on the path of undisciplined spending and it's not have a check and balance with the parties that be, then definitely there could be a higher probability that that could happen.
I wonder, if you look at the UBS, I mean, Lisa mentioned Joe Jett a little while ago at Kidder Peabody. For those who remember, that was here in New York, but the other instances have been at SocGen, at UBS, at Barings. Do Europeans, and as well as the whole sovereign situation, do Europeans focus less on risk? Are they are they more tolerant of issues like that? I mean, why does that always happen over there?
Well, I'm really shocked that after 2008 that you could have the head of a risk management of a major bank not understand the positioning of some of their traders. I know at Manulife and John Hancock, we have an insurance culture, show our risk parameters. Every day we have to prove, and every day we have to have compliance issues to make sure we're in line with the rules of our strategy. On the trading side, when I worked in New York, we had to prove our P&L within $1,000 every day, so it was pretty strict when I worked at Morgan Stanley. So that room for error or having trades under the desk or in the desk was pretty few and far between.
You think this is the beginning of a bigger issue, or is this a one-off event?
I'm of the opinion it's a one-off event. What concerns me is going through 08, you would thought you would have the check and balance in that system to make sure that you could find any sort of rogue element or a trading situation that didn't make sense. That sort of surprises me, currently.
All right, and we have to end it there. Thanks so much. Good to see you once again. That was Dan Janis of Manulife Asset Management, lead portfolio manager there.